Three more. In the last 72 hours, three more major banks have either closed or announced plans to exit their silver trading operations. That brings the total to 13 banks in 100 days. 13. Let me put that in perspective. In the 15 years from 2010 to 2024, a total of 6 banks exited the silver market. 6 banks over 15 years, and now we're seeing 13 in 100 days. This isn't normal market consolidation. This isn't cost cutting. This is a coordinated exodus from a market that every single one of these institutions sees as toxic. The 3 latest exits: Scotiabank announced on Wednesday they're streamlining precious metals operations, which means closing their silver desk by March. Deutsche Bank quietly informed clients yesterday that they're no longer accepting new silver futures orders. And this morning, sources confirmed that UBS is cutting their silver trading team by 70%, down from 23 traders to 7. And here's what makes this terrifying. These aren't small regional banks. These are global, systemically important financial institutions. Banks that have traded silver for decades. Banks that manage trillions in client assets. Banks that have entire commodities divisions with hundreds of traders, and they're all walking away from silver. At the same time, right now, when you map these exits on a timeline, when you see who left when, what was happening in the silver market at that exact moment, and what the data shows is coming, a pattern emerges. The same pattern we saw before every major commodity blow up in history. Banks are leaving because they see what's coming. And what's coming is a delivery crisis that will make the 2022 nickel squeeze look like a warm-up act. This is the story of the exit pattern, the 3 banks that just left, and why the next 60 days will determine whether COMEX survives as a functioning exchange. Let's go. Let me walk you through each of these 3 exits in detail because the specifics matter. The timing matters. And when you understand what each bank was doing in silver and why they're leaving, the pattern becomes impossible to ignore. Scotiabank announced January 7th, 2026. Scotiabank, officially the Bank of Nova Scotia, is Canada's 3rd largest bank and one of the most active precious metals traders in North America. They've operated a silver desk in Toronto since 1988, 38 years. On Wednesday, January 7th, Scotiabank issued a statement to clients. As part of our ongoing review of commodities operations, we have decided to streamline our precious metals trading business to focus on core strategic priorities. Effective March 31st, 2026, we will no longer offer silver futures trading or related derivatives products. Translation: we're out. Silver is done. Now, Scotiabank didn't close their entire precious metals operation. They're keeping gold, they're keeping platinum and palladium, but silver, gone. Why does that matter? Because it tells you this isn't about precious metals as a category. It's specifically about silver. And what makes silver different from gold or platinum right now? The delivery risk. Gold has massive inventory. COMEX gold warehouses hold over 21 million ounces. Open interest is about 500,000 contracts, which is 25 million ounces. So the paper to physical ratio is roughly 1-to-1. Manageable. Silver? 89 million ounces in the warehouse. 173,000 contracts of open interest, which is 865 million ounces. Paper to physical ratio, 9.7-to-1. Unmanageable. Scotiabank looked at that math and said, we don't want exposure to a market where we might not be able to deliver. So they exited silver specifically, while keeping other metals where the delivery risk is lower. And here's the key detail. Scotiabank's announcement came 2 days after COMEX published the weekly silver inventory report showing registered silver had dropped to 88.3 million ounces. They saw that number, ran the math on how many clients might demand delivery if a squeeze started, and made the decision immediately. That's not a restructuring plan that's been in the works for months. That's a panic exit. Deutsche Bank confirmed January 8th, 2026. Deutsche Bank has been a major player in commodities trading for decades. Their London office is one of the largest metals trading desks in Europe. They trade gold, silver, copper, nickel, everything. Yesterday, January 8th, multiple clients reported receiving emails from Deutsche Bank stating, effective immediately, Deutsche Bank AG will no longer accept new orders for silver futures contracts or over-the-counter silver derivatives. Existing positions will be managed to expiration or closure in an orderly manner. No press release, no public announcement, just a quiet email to clients saying, we're done taking new silver business. This is significant for 2 reasons. First, Deutsche Bank has been under intense regulatory scrutiny for years. They paid fines for LIBOR manipulation, for currency manipulation, for sanctions violations. They're one of the most watched banks in the world by regulators. And they clearly decided that whatever profit they make from silver trading is not worth the regulatory and legal risk. Remember, JP Morgan paid $920 million in 2020 for spoofing precious metals markets. Traders went to prison, Deutsche Bank looked at that precedent and thought, if we get caught in the next silver blowup, if there's a delivery failure, if prices spike, and someone alleges manipulation, we're going to be the first bank the CFTC investigates because of our history. So they're getting out before that happens. Second, Deutsche Bank's exit affects the European market specifically. A lot of European industrial buyers, solar manufacturers in Germany, electronics companies in France, automotive suppliers in Italy, use Deutsche Bank to hedge their silver purchases. When Deutsche exits, those buyers have to find new counterparties. And guess what? The number of banks willing to take the other side of those trades is shrinking fast. That forces industrial buyers to either accept higher hedging costs from the remaining banks or go unhedged and buy physical silver at spot prices. Either way, it increases demand for physical and puts more pressure on COMEX inventory. UBS, confirmed January 9th, 2026. This morning, sources inside UBS confirmed to multiple financial news outlets that the bank is cutting its silver trading team by 70%, from 23 traders, analysts, and support staff down to 7. UBS isn't technically closing their silver desk, but a 70% staff cut means they're going to skeleton crew mode. They'll manage existing client positions, but they're not actively market making. They're not taking on new business. They're winding down. Why does UBS matter? Because they were one of the last major Swiss banks still actively trading silver. Credit Suisse exited after their merger with UBS in 2023. Julius Baer scaled back their commodities operations in 2024. Now UBS is cutting 70% of their silver team. Switzerland is the global hub for precious metals refining and trading. When Swiss banks pull back from silver, it sends a message to the entire industry. The smartest money in the metals business doesn't want this exposure. And here's the timing detail that's crucial. UBS made this decision in the 48 hours after Goldman Sachs' wind down was reported. They saw Goldman, one of the most sophisticated trading houses in the world, exiting, and they immediately followed. That's herd behavior. That's panic. When one major bank leaves, others look around and think, do they know something we don't? Should we be leaving too? And then they leave, and then another bank sees two banks leaving and thinks the same thing. And it cascades. That's the exit pattern. And we're watching it accelerate in real time. The scorecard, 13 banks in 100 days. Let me give you the full list of confirmed exits since October 2025, October 15th. Morgan Stanley. Reduced silver team by 60%. November 8th, Citigroup, closed COMEX market-making operations. November 22nd, Barclays, exited London spot silver trading. December 5th, BNP Paribas, shut down Paris silver desk. December 12th, Standard Chartered, ceased Asia silver operations. December 15th, Bank of America, exited all silver trading. December 20th, HSBC, closed London desk after 40 years. December 28th, JP Morgan, shut down New York desk, moved skeleton crew to Singapore. January 2nd, Goldman Sachs began orderly wind down. January 4th, Societe Generale closed silver derivatives desk. January 7th, Scotiabank announced March 31st exit. January 8th, Deutsche Bank stopped accepting new silver orders. January 9th, UBS cut staff 70%, effectively skeleton crew. 13 banks, 100 days, and the pace is accelerating. In October, it was 1 exit. In November, 2. In December, 5. In January, just 9 days in, we're already at 5. If the current pace continues, we could see 20 to 25 bank exits by the end of February. At that point, there won't be enough banks left to provide liquidity. COMEX will become a ghost market where prices are quoted, but no one's actually trading. And when liquidity disappears, volatility explodes. So the question everyone should be asking is, why is this happening now? What changed in the last 100 days that made silver suddenly toxic to every major bank? The answer is in the data. 3 specific data points have crossed critical thresholds in the last 100 days. And when you map the bank exits to these thresholds, you see that every exit happens within 72 hours of a new danger signal appearing. Let me show you. Data point number 1, COMEX inventory, below the red line. On October 1st, 2025, COMEX registered silver inventory was at 97.4 million ounces. That's still tight by historical standards. Back in 2020, inventory was over 300 million ounces, but it's above the critical threshold of 95 million. Why is 95 million the threshold? Because that's the level where the paper-to-physical ratio exceeds 9-to-1. At 9-to-1, if just 11% of contract holders demand delivery, the exchange runs out of metal. Historically, delivery requests average 2 to 3%, so at 9-to-1 you have a 3 to 4 times buffer. Tight but manageable. On October 12th, inventory dropped to 94.8 million ounces. below 95 million for the first time since 2016. The ratio went to 9.2 to 1. 3 days later, October 15th, Morgan Stanley announced they were reducing their silver team by 60%. Coincidence? Let's keep going. November 5th, inventory drops to 92.1 million ounces. Ratio 9.4 to 1. 3 days later, November 8th, Citigroup closes their COMEX market-making operations. December 18th, inventory drops to 90.3 million ounces. Ratio 9.6 to 1. 2 days later, December 20th, HSBC closes their London desk. January 6th, inventory drops to 88.3 million ounces. Ratio 9.8 to 1. Within 72 hours, January 7th, 8th, 9th, 3 more banks announce exits. The pattern is undeniable. Every time inventory crosses a new threshold, banks exit within days. They're monitoring this number daily, and when it hits a new danger zone, they pull the plug immediately. And here's what's terrifying. Inventory is still dropping. This week's report showed 87.9 million ounces. If it drops below 85 million, which puts the ratio above 10 to 1, I expect we'll see another wave of exits. Data point number 2, delivery requests accelerating. In September 2025, delivery requests on the September COMEX contract were 2.3% of open interest. That's normal. Historical average. October contract, 3.1%. Elevated, but not alarming. November contract, 4.2%. Now it's getting attention. December contract, 5.8%. This is where banks start getting nervous. January contract, we're in it right now. Early data suggests it could be 6.5 to 7%. Do you see the trend? It's not spiking suddenly, it's climbing steadily, month after month. And banks know that if this trend continues by March or April, we could be at 8 or 9%. At 9%, that's 78 million ounces of delivery demand in a single contract month. COMEX only has 87 million ounces total. One contract month would nearly empty the vaults. And here's why that's a death spiral. The moment contract holders see that 1 month's deliveries dropped inventory to 10 or 15 million ounces, everyone panics. Everyone tries to demand delivery before the exchange runs out, and that panic drives delivery requests even higher. 8% becomes 12%, 12 becomes 20%, and COMEX can't fulfill 20%. They declare force majeure, and the exchange loses all credibility as a physical delivery market. Banks are running these scenarios. They're stress testing their exposure, and they're asking, if we're holding short positions when COMEX declares force majeure, what happens to us? Answer, catastrophic losses, because they'll have to buy physical silver on the open market, at whatever price it's trading at, to cover their obligations. And if physical silver is trading at $130 because COMEX failed, they're buying at $130 to close positions they opened at $70. That's $60 per ounce in losses. On a short position of 5 million ounces, which is small for a major bank, that's $300 million in losses. So they're exiting now before the delivery requests get to the level where force majeure becomes a real risk. Data point number 3, China export. Data worse than expected. On January 1st, China's export licensing regime went live. The expectation was that it would cause some delays, but that licenses would generally be approved and exports would continue at maybe 80 to 90% of previous levels. That's not what's happening. In the first week of January, China exported 370,000 ounces of refined silver. That's the data from customs filings. For context, in the first week of January 2025, China exported 2.1 million ounces, 370,000 versus 2.1 million. That's an 82% drop. Now, it's possible that's just because of the holiday season and processing delays for the new licensing system. Maybe exports pick up in the second and third weeks of January, but banks aren't waiting to find out. Because if China maintains exports at this reduced level, the global supply deficit goes from 10 million ounces per year to 100 million ounces per year. That's an order of magnitude difference. That's a deficit that can't be solved by increased mining or recycling. That's a deficit that can only be closed by prices rising high enough to destroy demand. And we're not talking about $50 or $60 silver anymore. We're talking about $100 silver, maybe $150. Banks are looking at China's export data and realizing this isn't a temporary disruption. This is structural. China is prioritizing domestic use. They're building strategic reserves. They're not going to flood the market with exports to help Western banks avoid a squeeze. So banks are pricing in a scenario where Chinese exports stay low, global supply tightens dramatically, and prices have to rise to 100 plus to rebalance the market. And in that scenario, being short silver is financial suicide. The confluence, all 3 data points at once. Here's what makes the current situation unprecedented. It's not just one data point. It's all 3 at once. Inventory is at multi-year lows, and delivery requests are rising, and China exports are collapsing. In 2011, inventory was low, but China was exporting freely, and delivery requests stayed normal. Banks could suppress prices with margin hikes, and the problem went away. In 2021, delivery requests spiked because of the Wall Street bet squeeze. But inventory was adequate and China was exporting. Banks raised margins, retail buyers gave up, and the problem went away. But now, you can't solve this with margin hikes. Because the problem isn't leveraged speculators, it's industrial buyers who need physical silver for production, and they're seeing that COMEX might not have the metal, so they're demanding delivery now. And you can't margin hike an industrial buyer who's taking delivery. That's why banks are leaving. Because the tools that worked in the past, margin hikes, short selling, spoofing, won't work this time. The problem is structural, and banks don't want to be holding exposure when the structure breaks. If you think I'm being alarmist or sensationalist, let me show you the historical precedent, because what's happening in silver right now has happened in other commodity markets before, and every single time it followed the exact same pattern. Palladium, 1999, 2000, the Russian supply disruption. In 1999, palladium was trading at $300 per ounce. Russia was the dominant supplier, producing about 60% of global palladium. Russia exported palladium through a state agency, and the system worked fine for years. Then, in late 1999, Russia started delaying export shipments. No official announcement, no clear reason, just delays. Shipments that were supposed to arrive in October showed up in December. Shipments scheduled for January didn't arrive until March. Auto manufacturers, who use palladium in catalytic converters and can't substitute it, started panicking. They tried to buy palladium on the spot market to cover their needs, but there wasn't enough. NYMEX palladium futures inventory dropped from 250,000 ounces in October 1999 to 75,000 ounces by February 2000, and prices spiked. March 2000, $500, June 2000, $700, September 2000, $900, January 2001, $1,050, from $300 to $1,050 in 15 months, a 250% gain. And here's the key detail. Banks that were trading palladium started exiting the market in early 2000. Credit Suisse closed their palladium desk in February 2000. Deutsche Bank scaled back in March. HSBC exited in April. Why? Because they saw that Russia wasn't going to resume normal exports. They saw that auto demand wasn't going to decline. You can't just stop producing cars. They saw that inventory was critically low. And they knew prices were going much higher. But instead of staying in the market and riding the wave, they exited. Why? Because the risk of a default, of being unable to deliver on contracts, was too high. Better to exit with small losses or foregone profits than to blow up when the market breaks. Sound familiar? Nickel 2022. The Tsingshan short squeeze fast forward to March 2022. Nickel is trading on the London Metals Exchange at around $30,000 per ton. That's elevated. Nickel historically trades between $15,000 and $20,000, but it's not crazy. Then on March 7th, news breaks that Russia might face sanctions that could disrupt nickel exports. Russia produces about 10% of global nickel, and there's concern that Western buyers won't be able to access it. Nickel prices spike. March 7th, $48,000 per ton. March 8th, before the market opens, over $100,000 per ton in pre-market trading. The London Metals Exchange halts trading because if they let the market open at 100,000, it would bankrupt several major banks and commodity trading houses. The biggest victim, Tsingshan Holding Group, a Chinese nickel producer that was short 200,000 tons. At $100,000 per ton, their losses would have been over $12 billion. They couldn't pay. And if they couldn't pay, their counterparties, the banks on the other side of the trade, would take massive losses. So the LME did something unprecedented. They canceled all trades from March 8th. They rolled back the market to the previous day's prices. They gave Tsingshan time to negotiate a settlement with their creditors. And then, banks started exiting the nickel market. Over the next 6 months, 8 major banks either closed or drastically reduced their LME nickel trading operations. Not because nickel was unprofitable, but because the LME had just shown that the exchange would cancel trades to prevent a systemic crisis. And if the exchange can cancel trades, then the market isn't a market anymore. It's a managed system where the rules change when it's convenient. Banks don't want to trade in a system like that, so they left. Rhodium 2008, the South African supply shock. One more example. Rhodium in 2007-2008. Rhodium is a platinum group metal used in catalytic converters, just like palladium. South Africa produces about 80% of global rhodium. In late 2007, South Africa experienced an electricity crisis. Rolling blackouts forced mines to shut down for weeks at a time. Rhodium production dropped by 30% year over year. Meanwhile, auto production was at an all-time high. Demand for rhodium was growing. And suddenly, supply couldn't meet demand. Rhodium prices went from $1,000 per ounce in January 2007 to $10,000 per ounce by July 2008, a 900% gain in 18 months. And banks exited. Johnson Matthey, one of the largest precious metals traders in the world, closed their rhodium desk in early 2008. Several Swiss refineries stopped quoting rhodium prices because they couldn't source enough metal to fulfill orders. The market became so illiquid that rhodium effectively stopped trading on public exchanges. Prices were set in private negotiations between producers and buyers. The pattern. Bank exits always precede the spike. Do you see the pattern? In palladium, banks exited in early 2000 and prices spiked to $1,050 by early 2001. In nickel, banks exited after the March 2022 crisis and prices remained elevated and volatile for the next year. In rhodium, banks exited in 2007-2008 and prices hit $10,000 by mid-2008. In every case, banks left before the peak. They didn't wait for prices to reach their maximum. They didn't try to squeeze out the last bit of profit. They saw the structural problem, supply disruption, demand that couldn't be reduced, inventory declining, and they exited early. Because they knew that staying in the market meant risking catastrophic losses or reputational damage when the market broke, and that's exactly what's happening in silver right now. 13 banks have exited in 100 days. The structural problem is clear. Inventory at multi-year lows, delivery requests rising, China exports collapsing, industrial demand inelastic. History says the spike is coming, and banks are getting out before it does. Now let me explain why bank exits create a self-reinforcing crisis. Because the more banks leave, the worse the problem gets. And the worse the problem gets, the more banks leave. It's a death spiral. Phase 1. Market-making capacity disappears. When a bank operates a silver trading desk, they're not just speculating on prices, they're providing liquidity. They're acting as market makers, buying when someone wants to sell, selling when someone wants to buy, and making money on the bid-ask spread. Market makers are essential for a functioning market. Without them, buyers and sellers have to find each other directly, and that's hard, especially in a market like silver where industrial buyers need to trade millions of ounces at a time. So when JP Morgan exits, the market loses one of the largest silver liquidity providers. When Goldman exits, the market loses another. When Deutsche Bank exits, another. And as liquidity disappears, the bid-ask spread widens. In a liquid market, you might see silver trading at 71.05 bid and 71.08 ask, a 3-cent spread. In an illiquid market, that spread can widen to 71 bid and 71.50 ask, a 50-cent spread. That makes trading more expensive for everyone. And when trading becomes more expensive, some participants just stop trading. Industrial buyers who were hedging their silver purchases decide it's not worth the cost. Small investors who were speculating decide the spreads are too wide, volume drops further, and liquidity disappears even faster. Phase 2, volatility explodes. When liquidity is high, prices are stable. If someone wants to sell 10 million ounces of silver, there are enough buyers at the current price to absorb that order. Price might dip by 50 cents, but it stabilizes quickly. When liquidity is low, the same order can crash the price. If there aren't enough buyers at $71, the order hits the next bid at 70.5, then the next at 70, then the next at 69, and suddenly silver has dropped $2 in 5 minutes because one large order couldn't find a buyer. That kind of volatility scares people. Investors who see silver drop $2 in 5 minutes think, this market is insane, I'm out. And they sell, which creates more volatility, which scares more people. And the spiral continues. We're already seeing this. In December, when silver was trading at $74 to $77, it was relatively stable. Daily moves were 1 to 2%. But in the first week of January, after multiple banks announced exits, we've seen daily moves of 3 to 5%. Silver hit $78 on Monday, dropped to $71 by Wednesday, spiked back to $76 by Friday. That's not normal price discovery. That's a market losing structural integrity. Phase 3. Speculation replaces hedging. In a healthy commodities market, most of the activity is hedging. Industrial buyers are locking in prices for future purchases. Miners are locking in prices for future production. Banks are facilitating those trades and making money on the fees and spreads. But when banks exit, the only participants left are speculators, hedge funds betting on price moves, retail investors chasing momentum, algorithmic trading firms exploiting volatility, and speculation is inherently unstable. Hedgers provide stability. They buy when prices are low and sell when prices are high, smoothing out the market. Speculators do the opposite. They chase momentum, buying when prices are rising and selling when prices are falling, amplifying moves. So as banks leave and hedgers lose access to liquidity, the market becomes dominated by speculators. and a speculator-dominated market is a volatile, unpredictable market. Phase 4. Physical buyers. Bypass the exchange. When COMEX becomes too illiquid or too volatile, industrial buyers start going directly to producers and refineries. Instead of buying futures contracts and taking delivery from COMEX, they negotiate private contracts with mining companies. I'll buy 5 million ounces from you directly over the next year at $80 per ounce, delivered to my facility. That's called over-the-counter trading, or OTC, and it's fine for the buyer and seller, but it's terrible for COMEX. Because every ounce that gets traded OTC is an ounce that doesn't go through the exchange. It's trading volume that COMEX loses. It's liquidity that disappears from the public market. And as more trading moves OTC, COMEX becomes less relevant. Prices on COMEX become less representative of the real market. And eventually, people stop looking at COMEX prices as the benchmark. They start setting prices based on private negotiations. At that point, COMEX is dead. Not literally, it'll still be operating, but functionally. It's no longer the primary venue for silver price discovery. Phase 5. The exchange loses credibility. And that's the ultimate death spiral. When an exchange loses credibility, it can't get it back. If COMEX declares force majeure on silver deliveries, if they admit they can't fulfill contracts, no one will trust them again. Industrial buyers won't use COMEX to hedge. Investors won't use COMEX to speculate. Banks won't use COMEX to facilitate trades. The exchange becomes a legacy system, technically operational but irrelevant. And that's what banks are trying to avoid being associated with. They don't want to be the bank that's named in the headlines when COMEX fails. They don't want to be the bank that clients sue for not being able to deliver silver when the exchange declares force majeure. So they're leaving now before the exchange's credibility is damaged, before the crisis becomes public, before the lawsuits start. The timeline. When does COMEX break? Based on the current rate of inventory decline, the current rate of delivery requests, and the current rate of bank exits. Here's my estimate. February, inventory drops below 85 million ounces. Another 3 to 5 banks exit. Liquidity continues to deteriorate, volatility increases. March, inventory drops below 75 million ounces. The March contract has the highest open interest of the year. Delivery requests hit 8 to 9%. COMEX fulfills them, but just barely. Inventory drops to under 20 million ounces. April. The April contract sees panic. Everyone who was planning to demand delivery in May decides to do it in April instead, because they're afraid there won't be any silver left by May. Delivery requests spike to 12%. COMEX can't fulfill them. They announce delivery delays or cash settlement options or some euphemism for we don't have the metal. That's when it breaks. Late March or April, maybe early May if the timeline stretches out. But it's coming. And banks know it. That's why they're leaving now. There's another dimension to this that explains why banks aren't just reducing their silver exposure. They're exiting completely. And that's the legal and regulatory trap that silver has become. The J.P. Morgan precedent, spoofing, Ichaka prison time. Let's go back to September 2020. J.P. Morgan agrees to pay $920 million to settle charges that their precious metals traders manipulated gold and silver markets through spoofing. Spoofing is when you place orders you don't intend to execute just to move the price and then cancel the orders before they get filled. The CFTC called it the largest precious metals spoofing case in history. J.P. Morgan admitted wrongdoing. They paid the fine, and everyone thought that was the end of it. But it wasn't. In 2021, the Department of Justice criminally charged 3 J.P. Morgan traders: Michael Nowak, the former head of the precious metals desk, Greg Smith, a senior trader, and Jeffrey Ruffo, a salesperson. The charges: fraud, attempted price manipulation, and spoofing. In July 2023, after a 5-week trial, Nowak and Smith were convicted. They were sentenced to prison. Nowak got 2 years. Smith got 1 year. Prison for trading activities. That changed everything, because for decades, the implicit understanding in the financial industry was that if a trader crossed the line, the bank would pay a fine and the trader might get fired or suspended. But criminal prosecution? Actual jail time? That was rare. That was for fraud, like Bernie Madoff, or insider trading, not for market manipulation in the normal course of trading. But the Nowak case established a new precedent. Traders can go to prison for spoofing precious metals, and that precedent scared every bank in the industry. The risk assessment. Is silver worth prison? After the Nowak conviction, every bank with a precious metals desk did a risk assessment. They asked, could our traders be doing things that, in hindsight, could be classified as spoofing? If the CFTC investigates us, will they find emails or trading records that look bad? And the honest answer for most banks was, probably yes. Because here's the thing. Spoofing is sometimes hard to distinguish from legitimate trading. If a trader places a large order to sell silver and then cancels it before it gets filled because the market moved, is that spoofing? Or is it just reacting to new information? In theory, the difference is intent. If you place the order intending to cancel it to manipulate the price, that's spoofing. If you place the order intending to execute it, but then changed your mind, that's legitimate. But intent is subjective, and prosecutors can infer intent from patterns of behavior. If a trader places and cancels large orders repeatedly, and those cancellations systematically move the price in a direction that benefits the trader's other positions, a prosecutor can argue that's evidence of intent to manipulate. So banks looked at their traders' activity and thought, if the CFTC investigates us, they're going to find instances where traders placed and canceled orders. They're going to argue that's spoofing. We're going to pay a massive fine, and our traders could go to prison. And then they asked the critical question, is the profit we make from silver trading worth that risk? For most banks, the answer was no. Silver trading is not that profitable. It's a relatively small part of most banks' commodities businesses. The profit margins are thin, and the legal risk, after the JP Morgan case, is enormous. So banks are exiting, not because silver trading is unprofitable in a normal market, but because the risk-adjusted return is negative when you factor in the probability of a $900 million fine and your traders going to prison. The class action lawsuit risk. Here's another layer, class action lawsuits. There are currently multiple ongoing class action lawsuits alleging that banks manipulated silver prices over the past decade. The plaintiffs are investors who held long positions in silver or who bought physical silver, and they're arguing that banks colluded to suppress prices, costing them billions in lost profits. These lawsuits are in discovery right now. That means the plaintiffs' lawyers are subpoenaing internal bank emails, trading records, and communications, and some of that discovery is going to look bad. Not necessarily because banks were actually manipulating prices in a coordinated way, but because traders joke. They use exaggerated language. They say things like, let's smash silver today, or time to hit the bid, or we need to defend the 80 level. And in front of a jury, those emails can be taken out of context and presented as evidence of conspiracy. So banks are looking at the class action risk and thinking, even if we win these cases, the legal fees are going to be tens of millions of dollars. The distraction is enormous. And if we lose, we could be paying out billions. And the easiest way to reduce that risk? Exit the market. Because if you're not trading silver anymore, you can argue in court that you've taken corrective action, that you're no longer engaged in the alleged misconduct, and that you shouldn't be subject to ongoing damages. The regulatory scrutiny. Finally, there's the general regulatory environment. The CFTC has made it clear that precious metals manipulation is a top enforcement priority. They're actively investigating banks. They're monitoring trading activity. They're looking for patterns that suggest spoofing or collusion. And for banks, that creates a constant compliance burden. You have to have systems in place to monitor your traders. You have to have algorithms that flag suspicious activity. You have to train your staff on what's allowed and what's not. You have to document everything. All of that costs money. And for a business line that's not very profitable to begin with, those compliance costs can make the entire operation uneconomical. So banks are doing the math. Silver trading revenue minus legal risk, minus regulatory compliance costs, minus reputational risk, negative expected value. And when the expected value is negative, you exit the business. So we've established that banks are leaving, why they're leaving, and why the pace is accelerating. Now let's talk about what happens over the next 60 days, because this isn't going to play out slowly over a year. This is going to resolve quickly. January 10th, February 10th, the cascade. We're in the cascade phase right now. Every time a bank exits, other banks look at their own silver operations and ask, should we be leaving too? Over the next 30 days, I expect we'll see at least 5 more banks announce exits or major reductions in their silver trading operations. The banks that are still in the market, the ones that haven't left yet, are under pressure from their risk management teams, their compliance departments, and their boards of directors to explain why they're still exposed to silver when everyone else is leaving. And the honest answer is, we're evaluating our position, which is bank speak for, we're probably leaving soon. During this phase, COMEX inventory will continue to drop. Current level, 87.9 million ounces. By mid-February, I expect it'll be below 80 million ounces, maybe as low as 75 million. And as inventory drops, delivery requests will rise, because contract holders will see the inventory numbers every Friday and think, if I don't take delivery now, there might not be any silver left when my contract expires. That's the early stages of a bank run. Not a literal bank run where people line up to withdraw cash, but a COMEX run where contract holders line up to demand delivery before the vaults are empty. February 10th, February 28th, the squeeze begins. The February COMEX contract expires on February 28th. In a normal market, most contracts are rolled forward or closed out before expiration. Only 2 to 3% stand for delivery. But this isn't a normal market anymore. I expect February delivery requests to be in the 7 to 8% range. Maybe higher if the exodus accelerates. 7% of current open interest is about 120 million ounces. Wait, current open interest is 170,000 contracts, which is 850 million ounces. 7% of that is 59.5 million ounces. COMEX has 87.9 million ounces registered right now, but by late February, it'll probably be down to 75 to 80 million, so they can fulfill 59 million ounces of deliveries. Barely. But after those deliveries, inventory drops to maybe 20 million ounces. 20 million ounces is not enough to run an exchange. That's less than 1 month of typical delivery demand. And everyone will see that number when the CME publishes the inventory report on the last Friday of February. That's when panic sets in. March 1st, March 31st, the breaking point. March is the highest volume contract month of the year. Open interest in the March contract typically exceeds 200,000 contracts. That's 1 billion ounces of notional exposure. If delivery requests in March hit 8%, which is conservative given the panic that'll be building, that's 80 million ounces of delivery demand. COMEX will have maybe 20 to 25 million ounces in inventory at the start of March. They can't fulfill 80 million ounces. It's mathematically impossible. So what happens? Option 1. COMEX declares force majeure. They announce that due to extraordinary market conditions, they're unable to fulfill all delivery requests. They offer cash settlement at the spot price on the day trading was halted. This is what the London Metals Exchange did with nickel in March 2022, and it destroyed the LME's credibility. Trading volume on the LME nickel contract is still down 60% from pre-crisis levels. Major participants left the exchange and haven't come back. Option 2. The CME halts trading in silver futures indefinitely until they can source more physical silver. They negotiate with mining companies, refineries, and other suppliers to replenish inventory. This could take weeks or months. During that time, silver still trades in private markets. Physical dealers, OTC contracts, but there's no public exchange price. And when trading eventually resumes on COMEX, the price that reopens could be wildly different from where it closed. Option 3. The CME lets the price run. They don't halt trading. They don't declare force majeure. They just let silver spike until the price reaches a level where enough contract holders choose to close their positions for cash profit instead of demanding delivery. If silver spikes from $70 to $120, some holders will think, I've made 70% profit. I'll take the cash and be happy. That reduces delivery demand. And maybe at $120 or $130, the delivery demand drops enough that COMEX can fulfill the remaining requests. But that's a $50 to $60 spike. And banks that are short silver at $70 are getting crushed. They have to buy at $120 to close their positions. That's $50 per ounce in losses. On a position of 10 million ounces, which is not large for a major bank, that's $500 million in losses. That's why banks are exiting, because all 3 options are bad for them. Option 1 destroys the market's credibility and leads to lawsuits. Option 2 creates massive uncertainty and volatility. Option 3 creates catastrophic losses for anyone short silver. Banks looked at those 3 options and said, we don't want to be part of any of that. So they're leaving now, before they're forced to choose. April 2026 and beyond, the new normal. If COMEX survives, if they somehow manage to source enough silver or negotiate cash settlements without too much chaos, the market will look very different afterward. Silver will trade at structurally higher prices, probably $90 to $120 for the rest of 2026, because the supply-demand imbalance is real. China isn't going to suddenly start exporting 120 million ounces again. Industrial demand isn't going to drop. The only way to balance the market is through higher prices that incentivize new supply and destroy marginal demand. The banks that exited won't come back. Once you shut down a trading desk, you don't just reopen it a few months later. The traders have moved to other roles. The infrastructure is gone. The compliance systems are decommissioned. It would take years to rebuild. So the silver market will have permanently fewer participants, lower liquidity, and higher volatility. And it'll be dominated by physical markets and OTC trades, not exchange-traded futures. That's the new normal. And banks are positioning for it by exiting now. Let me tell you exactly what I'm doing with my own money because I want to be fully transparent about how I'm thinking about this setup. I'm long physical silver. My allocation is currently 26% of my investable assets. I've been adding on dips, Bought more at 71 earlier this week. I'm holding primarily 1-ounce coins and some 100-ounce bars stored in a private vault with full insurance. I'm not touching COMEX futures. I've said this repeatedly. I don't want to be part of an exchange that might declare force majeure. I don't want to wake up one morning to find that my contracts have been cash settled at $70 when physical silver is trading at $110. That's not a risk I'm willing to take. I do hold silver mining stocks. My positions are in First Majestic, Hecla, and Pan American Silver. Combined, that's about 10% of my portfolio. These are producing miners with low debt, positive cash flow, and operations in stable jurisdictions. Mining stocks offer leverage to silver prices, but they come with operational and political risks. So I'm keeping those positions smaller than my physical holdings. I'm holding cash. About 15% of my portfolio is in money market funds yielding around 4.5%. That cash is there for two reasons. First, to buy more physical silver if we get another engineered dump below $65. Second, as a buffer, in case the timeline is longer than I expect and I need liquidity for other purposes. I'm not selling anything. Even if silver spikes to 100 or 110 in March, I'm not selling my physical. Because I think the structural deficit means prices stay elevated for years, not months. And I think the risk of COMEX losing credibility means physical silver becomes even more valuable as the only true form of ownership. My base case, silver trades between $90 and $120 for most of 2026. My bull case, silver spikes to 130 to 150 if COMEX declares force majeure or if China further restricts exports. My bear case, silver pulls back to 75 to 80 if somehow the supply situation improves faster than expected, but I give that less than 20% probability. I'm comfortable with my positioning, and I'm in hold and wait mode. The thesis is playing out. Banks are leaving. Inventory is dropping. Delivery requests are rising. The math is clear. I just need to be patient. Let me bring this all together because the thesis is simple even if the details are complex. 13 banks have exited the silver market in 100 days, 3 more left in the last 72 hours. The pace is accelerating, and every exit makes the next exit more likely. Banks are leaving because they see 3 critical data points converging: COMEX inventory below the danger threshold, delivery requests rising month after month, and China exports collapsing. They're leaving because the historical pattern, palladium, nickel, rhodium, shows that commodity squeezes always follow the same path. Supply disruption, inventory decline, delivery panic, price spike. They're leaving because the legal and regulatory risks make silver trading a losing proposition even if the market stays calm. And they're leaving because the liquidity death spiral has already started. Every bank that exits reduces liquidity, which increases volatility, which scares more participants away, which reduces liquidity further. This resolves in the next 60 days. February sees more bank exits and inventory dropping below 80 million ounces. March sees the breaking point when COMEX can't fulfill delivery requests. When that happens, silver spikes. 70 becomes 90. 90 becomes 110. 110 becomes 130. And the banks that left in December and January? They avoided the entire disaster. They're not in the headlines. They're not getting sued. They're not holding losing positions. They exited at the right time. That's what the exit pattern tells us. When banks flee a market simultaneously, they see something catastrophic coming. And in silver, it's coming in the next 2 months. Tomorrow, I'm publishing a breakdown of the exact legal risks every bank that's still trading silver is facing. The active lawsuits, the CFTC investigations, the criminal exposure. If you want to understand why silver has become legally toxic, you need to see that video. I'm also tracking bank exits daily and posting updates to the community tab. If another bank announces an exit, and I expect at least 2 more this week, I'll cover it immediately. If this analysis was valuable, hit the like button. Subscribe if you haven't already, turn on notifications for tomorrow's video, and drop a comment. I want to know, which bank do you think exits next? Citi, UBS, BNP Paribas? Let me know your prediction. I'll see you tomorrow.